Welcome to Your Time, Your Money, the show where your time is just as valuable as your money, and we know that. Thank you for so much for tuning in today. Today we're going to discuss the investment seesaw, and I thought it was prudent to put in context balancing investments in relation to a seesaw. A lot of times you'll hear, oh, you should have a 80-20 split, so 80% stock, 20% bond. Maybe if you're younger, there's strategies out there that say, hey, your bond should match your age in a portfolio. There's other strategies that say a 60-40 blend is going to get you through retirement. Whatever that strategy is, it's important that we understand the correlation or non-correlation of assets on a seesaw. So if we think about a seesaw and we put the center of a seesaw, we put the word cash on that center of that seesaw, right? The center of a seesaw doesn't fluctuate. It's pretty stable. Actually, it's that point of pivot, so you don't really see any fluctuation in there. But I think it's important to understand it's a point of pivot, meaning if you're investing from one side of the seesaw to the other, it's got to pass through cash at some point. So either you're locking in a return or you're locking in a loss, depending when you're rebalancing your seesaw. But on that investment seesaw, as you go out, your investments become what? More aggressive or more volatile, right? We all know if you sit on the far end of a seesaw, it's going to go up and down a lot higher than it would if you were sitting closer to the center. So on a seesaw, I want you to think of two sides, the stock side and the bond side. On the stock side, as you move out from the center, you have large cap stocks, you have mid cap stocks, and you have small cap stocks. Now, I know there's a lot of different stocks and blended funds and stuff in between there. I'm just talking generic. But large cap stocks are your large companies, your S&P type companies, things like Walmart, things like Amazon, things that aren't going to collapse overnight or fold overnight, hopefully, right? And as you go out, you have mid-sized companies, and then all the way out to small-sized companies. On the bond side, you have government bonds. That's closer to the center, followed by corporate bonds, right, which corporate bonds themselves could also be large, mid, and small. And you have high yield bonds, or sometimes known as junk bonds, a lower credit quality rating bond. And I think it's important to understand where each of those things are on a seesaw, because if you are a more conservative investor, it doesn't mean moving all your assets to the bond side. Just like being more aggressive doesn't mean moving all your assets to the stock side. You can be balanced on both sides of that seesaw. So for instance, if you're a very aggressive investor, you may be out in the mid and small cap range, but you also may want to bring some balance in by going more high yield bonds, junk bonds, things, or corporate bonds in general. You can bring balance by being both aggressive and conservative. If you're conservative, instead of going all bond, you may want to go large cap and government bonds. But I think it's important that a listener understands how that seesaw works, the volatility on both the stock and bond side, and how that can play into your favor. Very simple concept. If you're looking at your accounts and you want to bring some diversification on both sides between fixed income and stock, think about that picture of the investment seesaw, and that should help you balance out a little bit more of how aggressive, conservative, or moderate that you want to be. As always, you can reach Iron Tree Financial at 43 British American Boulevard in Latham, New York, 12110. You can reach us at 844-444-YTYM for Your Time, Your Money. You can find links to our episodes at yourtimeyourmoney.net for your net worth. And as always, if you like this video, please subscribe and share, and send in your topics and other questions that you might have. As always, it's your time and your money.